Hi folks, and welcome to this video on question 3, part 2, which is doing the same question, E and J, but only we're going to use the entity theory. So we haven't changed the data at all, we're just doing the entity theory piece. Alright, so now one of the things that we said in class is that the parent company extension theory and the entity theory will give you two different numbers. You'll give you a different number for goodwill and a different number for NCI. All the other numbers should pretty much be the same. So let's have a look at that process and specifically see how it affects our consolidated balance sheet. So now, if we go to the solution, we're going to have a look at the calculation of the acquisition differential, goodwill, and NCI. Again, we paid $9,450, which is the value of the shares that we gave to the shareholders of J, times $27 a share. So $350 times 27 is $94.50. But we would have paid, under the entity theory, they believe that it's a linear relationship, right? They believe that we would have paid $13,500 to get 100% ownership interest. However, what did we get for that ownership interest that we have? We got the book value of net assets at $34,250, and again we get that by looking at the common shares and retained earnings of J, and don't forget the retained earnings of J was a deficit, right? $34,250. So the implied value of what we control, right, less the carrying value means that we've got a negative acquisition differential. That doesn't mean that we necessarily have negative goodwill. In this case, we happen to, but you don't have to. Let's see how that acquisition differential, which is negative $20,750, was allocated. Well, as we did in the first video, we allocated it to a decrement in the plant assets, and we also said that there was a decrement in the long-term debt. Why? Because the long-term debt in E's estimation is worth $2,600 less than what J's got it booked at. So when we add together this decrement in assets and this decrement in liabilities, and because this is going to debit the liability and this is going to credit the asset, the signage is opposite, we have a net allocation of negative $3,550 of this negative acquisition differential, which is negative $20,750. So what's left? Of this negative $20,750, we removed or allocated negative $3,550. So minus a minus is like a plus, and that's going to give us negative goodwill of $17,200. Now don't forget, negative goodwill, whether we're using PCE method or entity theory, that goodwill is going to be taken into a gain on E's books, but because we're at the end of the year, that gain on E's books would have got closed out to retained earnings. So we're going to show it on the consolidated balance sheet as going through consolidated retained earnings calculation. The one thing that is different, however, is how much of that bargain purchase gets recognized into E's income. Under PCE, we would only recognize the parent's share, but under entity theory, we recognize the whole 100%. So that's why I've got this in yellow. That's one of the two numbers that's going to be different than under PCE. The other thing is, when we calculate non-controlling interest, under PCE, we only took NCI's share of the fair value of J. Now we're not. We're taking 30% interest of the implied value of 100% of those assets, or what we would have paid. The implied value of what we would have paid for 100% of those assets. So 30% of $13,500 is $44,050. So these two numbers are different than under PCE. So now if we do our worksheet entry at acquisition, acquisition date should be December 31st. Sorry about that. What will we see? We'll see again, we're eliminating the common shares and retained earnings of J, and again it's a credit because it is a deficit. We're debiting the long-term debt to show it at its fair value on the consolidated balance sheet. We're going to record on the third set of books, not the separate entity books, but on the third set of books, $6,150 decrement. We're booking our NCI at $4,050, and we're eliminating the investment account. All right. Now, what impact does this have on the consolidated balance sheet? This is identical to what we had under the parent company extension theory. All of these numbers here in the asset section are the same because all we did was adjust the cash of E to account for the fact that they had acquisition costs and the cost of issuing shares that they had to pay out in cash, $44.90. And we're also recognizing the decrement on the plant assets, which the consolidated entity has to take on. We did this under PCE. No change here. Where the change comes, you can see, no change to current liabilities and long-term debt, as well as no change to common shares as it was under PCE. Why? We're making the same adjustments. We're minusing $2,600 from the long-term debt of the sub because we're picking it up at its fair value, which is lower than the carrying value of $45,200 booked by J. We're still eliminating $1,860. That's the offset. That was the cost of issuing the shares, right? And don't forget, we still need to add in the value of the shares that we as E issue to the shareholders of J to get their shares, right? So that's $94.50. So we still have the same number here, $163,190. What does differ here is the balance in retained earnings and non-controlling interest. Why? Because don't forget, that gain on the bargain purchase, which is $17,200, it now, don't forget, got closed out on E separate entity statements to retained earnings. So we have to increase the consolidated retained earnings by $17,200, and then here we're going to deduct the cost of doing the deal, which we already know was the cost of arranging the acquisition of $26.30. That's going to give us a different number here. That's why I've highlighted it in yellow, because we're adding in $17,200. The old number under PCE was different. It was $12,040. So now our retained earnings is $106,070 consolidated. Don't forget, we just finished calculating a new number for NCI. Don't forget, under the entity theory, NCI takes its share, which in our case is 30% of the implied value of 100%, and that gives us $4,050. So these two numbers are different. This number here is a little bit higher, and this number is lower by the same amount. So we're still going to get a balance sheet that balances, and in this case it's going to balance to $509,110. As we said earlier when we were discussing PCE, notice in the asset section there's no investment in J account. It's not shown because don't forget, when you did the acquisition eliminating entry, you eliminated the investment. And what did you do? On the consolidated statements, you eliminated the common shares and retained earnings of J. You set up the decrement in the long-term debt. You set up the adjustment to the retained gain on purchase or retained earnings of E, which was $17,200. You've got it here. You've set up the decrement in the P&E, which you've got here, and you've also set up your NCI, which you've got over here. So by the fact that you've set all these things up, you're eliminating the investment account. So that's why it's not here. Don't forget, at the date the two became related, E would have debited that investment account, right? And credited its common shares for $94.50, right? So in this case, we eliminated that investment account by crediting it, and so we have a balanced balance sheet. If you didn't know that this was happening when you did your worksheet entry, you're going to have an investment account here in J. It's going to have $94.50 in it, and clearly your balance sheet wouldn't balance. Hopefully you found this video helpful in understanding the concept of negative goodwill when we use the entity theory.